Hi, everyone. I would like to welcome you to Saga Partners annual meeting. It's really great to have everyone be able to join, and I appreciate you taking the time out of your day to talk about what I think is everybody's favorite topic, which is investing. This meeting is the best opportunity I have to speak with you directly and share how I've been thinking about the Saga portfolio and, more importantly, to answer your questions. This meeting's for you, and I tend to talk a lot, so I tried this year to condense the formal presentation so I can let you guys guide the conversation to a greater extent. But I still thought it was important to discuss an overview of Saga's philosophy and go from there. So for today's agenda, I'll start with a discussion of Saga's investing philosophy. I cover this every year, but I think it is important to continue to re-emphasize what can be a slightly different angle of how I approach investing. And I want to explain what we're trying to do and how we're trying to do it. And then from there, I'll discuss the results and open it up for Q&A. So excited to get going. So the investing problem. Everyone that has savings has the investing problem, and it's what to do with my money. And I've thought about this problem a lot, and there's an infinite number of solutions that are available out there, whether it's investing in stocks or bonds or currencies, commodities, Bitcoin, and those are all the solutions that are available. But I wanted to go a bit deeper and spend maybe 10 or 15 minutes to discuss it from a philosophical standpoint, which can be a little abstract, but I think it's very important because this is the framework for the foundation of fundamental investing. At its core, the investing problem is what to do with my wealth. And to make a good decision about what to do with my wealth, it's good to have a definition of wealth. The best and most fundamental definition of wealth that I have come across is from David Deutsch. He states that wealth is the range of physical transformation one is able to bring about to solve problems. If you take that definition of wealth seriously, wealth is not about money. It's about the ability to solve problems that we come across throughout life. The only way that we can grow our ability to solve problems is by having knowledge and the resources to do so. So this ties wealth to knowledge. And so if we want to grow wealth, it is really helpful to understand how knowledge is created and its characteristics. And it doesn't matter whether it's an individual creating wealth, a company, or really the broader economy, it is the fundamental thing that drives wealth. And businesses and markets are shaped by how knowledge grows. Knowledge is good explanations. Good explanations tells us how the world works. They don't just describe what happens, but they tell us why something happens. They explain what we see and experience in terms of what we don't see and experience. They connect the unseen to the seen. Once people understand how something works, they can manipulate reality in ways that were impossible without the ability, but they were impossible without that knowledge, and eventually lead to wealth. So from this definition of knowledge, we can think about its characteristics. And so the key characteristics of wealth are it's hard to create. There's an infinite amount of bad ideas that don't make sense, and very few that are actually good, hard to vary explanations. But the thing about knowledge is once you create it, it can be copied. Once you know how to create a fire, someone else can also take that knowledge and create a fire as well. It's replicable. Even though it's hard to create, people can copy it. The growth of knowledge is also inherently unpredictable. If we could predict future knowledge, then we would have it today. Those are the three very important characteristics of knowledge. How does this apply to business? What does this mean for business? Because we're thinking about investing. And business, at its core, is a problem-solving institution. It's a way to scale knowledge creation. So a quick history lesson that for almost all of human history, people created knowledge individually. We solved our immediate problems that arose for survival, essentially. But after the Enlightenment, about 300 years ago or so, The Enlightenment created a culture of criticism, and knowledge began to accumulate at a compounding rate faster than ever before. And specialization became increasingly possible, and people no longer had to reinvent existing solutions. They could pay others for what they already figured out, and then could focus on new, better problems. As problems grew more complex, they required greater resources. They required greater coordination and capital beyond what an individual could manage. So the corporate form emerged to apply knowledge at scale. And so that's when companies came about. And the modern corporations, just roughly in the mid 1800s into late 1800s, is when the modern corporation really formed. And we were able to invest in those. But how does this knowledge creation, why is this important for business? Well, because knowledge is hard to create, creating a business is very hard, because business is a reflection of the knowledge it uses to solve problems. There's an infinite number of bad business ideas, very few that actually solve problems. But once they are created, that knowledge can be copied. So therefore, competitive advantages of a business are temporary. There's very few that are very durable. In a free market, someone can take the knowledge and reduce any excess profits. And then thirdly, the growth of knowledge is unpredictable. Therefore, disruption of a business is always a risk. Even a dominant business can be overtaken by new solutions we have not even imagined before. So that implies, the implication is that few business ventures actually succeed. Even fewer have durable outsized profits, and only those that continue to create hard to vary knowledge endure. And that's, I think, important to understand in the framework of when you look at business to invest. But really, what does this mean for investing? At the core, the job of an investor is to value businesses, to create better explanations about a company's potential than the market has. Every stock price is a collective theory about a company's ability to solve problems. And like all theories, these market predictions can be fallible, they can be wrong. And so investing is fundamentally a problem-solving exercise. Undervalued stocks exist when the market underestimates a company's knowledge and problem-solving ability. Active investors, such as what we're trying to do, develop a better explanation to help allocate capital to where it is better deserved. And by directing resources toward a business most capable of creating value, investors with good theories improve the efficiency of the economy as a whole. The implication is, because few businesses create durable value, and most of the value is well understood by the market is pretty good at trying to assess businesses' knowledge creating ability, opportunities to find truly undervalued companies is rare. So that's, I think, a good framework to understand how to approach investing with that background. I wanted to give an example, so it's not so esoteric, about what a bad investment thesis is or a good investment thesis. And because you hear them, there's an infinite number of bad investment theses. There's a lot of different examples I was coming up with, such as this stock sells for a low valuation multiple, therefore it's a good investment, or it's growing really fast. I like to invest in companies that have high growth, or it's going to beat consensus next quarter. It's a high quality company. These things are not good investment theses because they're easily variable. They don't actually tie the value a business creates with reality. And so in themselves, it goes on. I won't even say all these, but they're examples, because there is so much information and so many thoughts about, should I get in and out of stock markets? What's this risk? The key is trying to find durable value and see if the market's misvaluing that. That's the key of investing. So anyways, those are examples of some bad investment theses, and I'm happy to explain more about that. But I want to give you an example of a good investment thesis. A good investment thesis would be the company built an integrated infrastructure to buy, recondition, transport, finance, and sell used cars at a lower per unit cost than traditional used car dealers when fully utilized. This enables faster delivery, greater selection, and lower prices, creating a competitive advantage. And based on its attractive unit economics, Relative to competitors, scale advantages, and hard to replicate infrastructure, the company is positioned to achieve higher profitability than current market expectations suggest. Now, there's a lot in there, but that's because each part of that investment thesis is relevant and important. It is there is so much underlying to create that surface level investment thesis, to understand the industry dynamics, technological innovations, the culture of a business, the management's decision-making ability, risk of disruption. There's a lot that goes into getting there, and these are hard to find. If you change one aspect of that explanation, the thesis falls apart. So that's a good example of a bad investment thesis. There's an infinite number of them, and a good one, and those are hard to find. So that gets me through the philosophy part of the presentation. I can talk about it more, hopefully, in the Q&A if people have greater questions, but I want to talk about the results. Talking about results is hard from investing because it's not a perfect input-output correlation of good decisions lead to good results or bad decisions lead to bad results. Good decisions can lead to bad results, but what I will say is the past 5 or 6 years have been wilder than I could have ever imagined. Crazy things can happen in the market. When I started Saga Partners almost 9 years ago, you have no idea what the future will hold. You just know that's going to be unpredictable, and you're just trying to make the best decisions possible. But we've since then lived through a global pandemic and unprecedented fiscal and monetary policy and a banking crisis people even forget about, and rapid technological shifts and market cycles where prices have swung from euphoric highs and to deep pessimism in record time. It's wild to reflect on just all that has happened over the last 8 or 9 years. I certainly never planned or anticipated the crash of the Saga portfolio in 2022, just as I didn't plan for its subsequent recovery. But through it all, my focus always remained on making the best decisions I can with the knowledge I have, and understanding businesses deeply, judging the durability of their competitive advantages, and weighing the price against its value. What is unusual about the Saga portfolio is that people say, how did you recover? It's very rare to see a portfolio crash the way it did, and then not only recover, but provide strong market outperformance since inception. And what is unusual is that for the most part, the Saga portfolio held the same exact companies throughout. Yet the market valued them at dramatically different prices within a very short time frame. And so it's wild. So I just continue doing what made the most sense to me and let the stocks eventually reflect whether those were good or bad decisions. So while stocks can move wildly at any moment for any reason, being at the mercy of whatever the headline risk is of the day, whether it's tariff wars or whatnot, but over the long horizon, consistently making good decisions will compound in really attractive results. And that is the essence of Saga's approach. Well, I'm always a little hesitant to look at stock results and see how great they are, or use them as a signal to whether it was good decision making or not. You do have to look at a scoreboard eventually. Results are the reality check that tells us whether the decision making was actually aligned with how the world actually works, rather than how we want the world to work. Over time, the scoreboard doesn't perfectly reflect the decision-making of value, but it generally should if you make enough good decisions. And what I will say is, I'll reflect a little bit on how I interpret Saga Partners results, giving it more of my thoughts and more color around them. So since inception, if you fell asleep over the last 8.5 or so years, the Saga portfolio compounded at 21% after fees. The S&P 500 did 15%, which is better than I would have hoped for from inception, not knowing the upswing and the downswing in the middle. But that performance, if continued, is exceeding my expectations of what can be done. But I think another implication about going all the way back to the inception of Saga portfolio, as those of you who have been here since the start, things have changed. There's that saying that no man stepped in the same river twice because it was a different river and different man. So experience changes us. And I do have probably a couple more gray hairs over the last couple of years, but I do think there was a change in how the portfolio was managed. When I started, I joined a partner, and we were focused on small and mid caps, which I had a lot of cognitive dissonance about that because I always wanted to find the best opportunities that were out there. And so eventually I kind of joined and adopted this portfolio, and I didn't really take it over and became the main decision maker until about the beginning of 2019. That reflects more of what the Saga portfolio's investment theory and philosophy is. It does paint things in a better light. Since 2019, things have compounded. The returns have been 25% over the last 7 or so years. The crash in 2022 was all of my decision making, and that was reflected the Saga portfolio. Because initially we were more diversified and focusing on different ideas. And I always have been one to focus on the best ideas. And that has been more of the portfolio management structure over the last 7 years. And then there's investors joined in 2020 and 2021. And the results since then have not been so strong. Like the returns have been about 5 or 10%. And that's decent, I guess, especially when you compare it to what most investment portfolios provide. But like for the huge volatility, is it really worth it? And so is this a good return for the risk? Then there's those who are probably better market timers than I could ever imagine, joined us in 2022 and 2023 and have had 125% return, annualized returns over the last 3 years. When I'm thinking about the performance, the last 5 or 6 years have been crazier than I ever imagined. And the portfolio is managed in the same way it was in 2021 and 2022. I do think my knowledge and understanding of businesses has grown, but it is always possible to go through another crash when you manage a concentrated portfolio. But I would think that returns should beat the market over the long term. You can't promise that, but that's the expectation. What I can say is 125% returns are not possible over the long term. We were in a weird environment. So people that joined in 2023 or 2022 think I may be a genius, or ones in 2020 think I'm an idiot. But I don't think that's the case, because people that come in the Saga portfolio really do have this long-term outlook. I make sure of that to make sure that people are aligned with trying to go through the ups and downs, and at the minimum have a 5-year time horizon. So when we do go through chaotic times in the market, you don't have to be a forced seller, because that is the key to really outperforming. Is you do not sell when the market is screaming fire. You sell when you're like, I need this money in 5 or 10 years. I need to have a plan for monetizing my investment in these companies. So that was a long rant about the results, but I thought it's important to give my thoughts about them, and it does help frame what we've been through and where we're going from there. What's important, I think, is when you look at your investment options, you look at what's available. What's interesting is, despite the craziness of what the results have been over the last 7, 8+ years, the Saga portfolio, if you look at all of the mutual funds available, at least on Morningstar's database, there's about 1,800 that started in the year beginning of 2017. So over the last 8.75 years, Saga Partners is the 9th out of 1,800. And now we're playing a much different game, but if you look at what mutual funds do over time, almost none outperform the market. In fact, of those 1,800, only 200 or 10% beat the market. And the same goes for, if you look at the results over the last 7 years, the Saga portfolio would be the 2nd best returning investment strategy of all the US equity mutual funds available. How is that possible? How is essentially a one-man shop able to manage a stock portfolio better than the essentially infinite resources of professional money managers? And I won't really dig into all the reasons unless someone's interested in digging deeper, but there are a lot of constraints for mutual funds, whether it is diversification or the principal agent conflict, that don't align the interests of returns as opposed to marketability. But there's a lot of different reasons. The thing is, what the Saga portfolio is attempting to do is make the best decisions over the long term possible. And that's all I'm really trying to do. So those are the results. And now we're about to start the Q&A session. But before we get into the Q&A, I just want to say thank you to all of the investors in the Saga portfolio. For those that started, they were my closest friends, my family. I am so excited to have you guys on this multi-decade journey. The portfolio exists because of investors who understand and share its long-term philosophy and its unconventional approach to investing that I think makes the most sense. I couldn't manage the portfolio in the way that I do without having aligned investors. And so thank you. So that's the end of the formal presentation. I'll open it up for Q&A. I'm excited for your questions. And I think the easiest way is people can either message in the box to ask a question or raise their hand and I can call on you. So with that, let's see. If you have a question, feel free to raise your hand. Okay, Michael.
Hey, Joe, very happy to be here. It's good to see
Hi,
you.
thanks for joining.
So obviously AI has become indispensable for many of us personally and professionally. Curious to know how has that changed your work and in what ways are you using it in your investing process?
Yeah, thank you. AI is a big topic and it's amazing technology. I use it daily. In fact, it's almost replaced my use of Google. It's quite amazing what is able to be done with it. And there's a lot of different ways to talk about AI, whether how it impacts investing or the research process. From the research process, it makes gathering information so much faster and so much easier. Any question I have in the world, it can just quickly put it in this, and the results are so much more easily to digest than going through Google, which just links that query to different sites and documents where then you can go through it. And Google's also an AI with Gemini and whatnot. It does make the research process much better and easier to digest all the infinite amount of data. From an investing point of view, I think it's important to just explain what AI is. And AI is a chat box. It's a really good chat box. It finds patterns across everything that's connected to its data and finds correlations and patterns, and then it provides you an output that is really relevant, but it's not thinking. It's not actually general intelligence. The only things that can create new knowledge are people. Explanatory knowledge are people. And so if you read David Deutsch's book, he discusses a lot about AI. It is possible to have a computer become a person and create new knowledge. And that is possible, but we don't have that. And actually what the AI technology is currently doing is going towards the opposite of what a person is. The current AI is getting a more refined output. It's doing a better response for a job. While a person, if a computer was a person, you would ask it a question and it could say, I don't feel like answering that, or I'm bored. Or if I play this chess game better to win better, AI will do it. But a general intelligence would say, I don't feel like playing chess. I feel like checkers, or I can do anything it wants. It's a person. And if you want to create new knowledge, you have to be a person. The current AI won't find a new cure for cancer. A person will do that. But AI is a technological tool that makes things easier to do. It takes off the manual labor of doing certain tasks, which is what all technology has done, whether it was the internet, railroads, or telephone. So it's huge. I love the technology. I think it's amazing, and I use it daily.
Thanks, Joe.
David. Dave? Hey, Dave. Are you able to speak? Are you on mute? Okay, Dave, if you still have your question, you can try to answer. I think you were maybe on mute. All right, Randy?
Thanks, Joe, and congratulations on the performance. Here's a question. So let's just say you have a stock that drops, 10% in a day. What tools do you use to enact the discipline you've talked about? So let's say a company comes out with a giant surprise, stock drops 10%, and you, like any human being, say to yourself, oh my God, should I be selling? And you know intuitively that that's not your strategy to react to some one-day news event, but do you have tools that you use to reassure yourself? How do you talk yourself off the ledge or reassure yourself? You go back and read your old letters and to say, no, this is not what we do, and we don't panic and react to one day's news and extrapolate that out for the next 10 years and assume the company's going to zero. Are there tools you're using to talk yourself off the ledge when there's some short-term news or situation?
Yeah. So volatility. So when a stock changes in a certain day, whether it's up or down, what the market is trying to do, it updated its thesis. The market has updated its consensus view of the stock. So I'd be interested in saying, does the market know something that I don't know or that I didn't incorporate in my thesis? So I try to understand potentially if it's a material move, I want to understand what the market potentially is thinking. If the stock goes down 10, 20, 30, 50, 90%, it can be material. And so I'm trying to understand what the market is thinking. I don't have to know because really I just have my understanding of the business and my thesis for how it will create knowledge and solve problems in the future. So let's say if it's tariff tantrums, the market's generally down today. The thing about investing is that in itself doesn't impact my thoughts on a specific company because investing is a relative game. So it's not about should I be in or out of the market. It's about if I were to invest over the next 10 or 20 years, what are the best opportunities available? So if the Fed raises interest rates or we go through a recession or we have a tariff trade war, that doesn't change the relative attractiveness of the specific investments per se. If there was a specific implication for a business that there's a regulation that impacts how it can do business or something to that extent, that would be material and I would incorporate that. But that's what I'm looking for. I'm trying to say, will this impact the value of this business over the long term? And how does that then relate to all the other opportunities? That's how I think about it. So I've become a little bit numb to volatility over the last 5 or 6 years. I don't know the exact reason for the volatility in the last couple of years of the market, but before COVID, before the pandemic, a company would report earnings for the quarter and the stock might move 5 or 10% up or down based on consensus or whatever reason. And now stocks, really large cap and very blue chip stocks even, are moving 20, 30+% after reporting. Those moves are huge for a company that may be very stable and very understandable. There's something weird going on, and I don't necessarily will speculate on why that may or may not be the case. I'm just trying to get an understanding for the business's value creation. And if the market, if my understanding of the business, let's use Carvana, for example, because that's the one that's like the headline, that was a large position and saw the biggest drop. Yes, Carvana was going through problems during 2022. And one thing I like to think about is like, how would, if everyone invested like me, like if everyone invested with this knowledge-based approach, what would be a value for the company? How does it change based on information? I have this valuation process in my head for a company like Carvana. If it goes through fundamental problems or issues or risks do increase, that value still does go down in my head. But does it long term, the stock price went much, much further down to the point where it was crazy to me about the theories that the market was generating about this. And it was really a bizarre experience because I don't know if I'll ever go through something like that again in my life. And if I do, it would be great. It's a once in a lifetime type of opportunity. But again, I guess to answer your question, Randy, I'm just trying to understand what the market's thinking. And most times it doesn't impact what I think the business will do over the long term. And if it does, it's also relative. So like if there is a nuclear bomb that gets dropped on the United States, that's going to impact the economy and lower the value of businesses. But which businesses are still the best relative to each other? So yeah, investing is a relative game, and there's a lot of noise and data that you have to cipher through. Very little of that data is truly meaningful and can help create new knowledge. So hopefully that answers your question.
Thank you.
Thanks, Randy. Vincent, I think can't quite hear. Can you try talking again?
All right, how's that sound now?
Okay, that's better. Thanks.
Hi, Joe. Thank you for hosting this. You mentioned, if I understood you correctly, in the early years, there's been an evolution kind of away from just small or mid caps. Mike, did I understand that correctly? Is there any such evolution or shifts underway these days in terms of what you're doing or how you're thinking about your portfolio structure? Related to that, the industry, I wonder about your industry kind of emphasis from here. Do you think of yourself as agnostic on industries, or are there certain areas where you're carving out a circle of competence?
Thanks. Yeah, so first was if there's been an evolution in the investing philosophy or how we approach investing besides the first 2 years, and another one is on kind of industry dynamic, or which industries I'm attracted to. But at first, when Saga Partners was started, there was this theory that we had that the best opportunities are in small mid caps, right? Like that's not where Wall Street looks, and you can uncover special opportunities under these rocks, but that's not the case. And there was a lot of things that we would potentially have passed on because they're like, oh, it's not within our threshold. And that's essentially what the industry does, is it buckets you into a box. Like you want to be a small cap, large cap, growth or value stock. And I completely didn't like that approach at all. I wanted to invest in the best opportunities I could find, whether it was a $1 billion company or a $50 billion company. That doesn't matter what the size of it. What matters is the value. And then has the approach evolved since 2019? And I don't think so. I think it's the same fundamental philosophy. I have refined it. And I think from an evolution of an investor, my evolution as an investor, there's been two big impacts to my life. One was when I came about Warren Buffett in late college, and I became obsessed and was enthralled by following his approach. His approach is so fundamental and so great. But even investing in high quality companies, selling at low multiples and that are stable. But there are so many examples where it didn't work. There was still like trying to understand why certain opportunities weren't working. And I did come about, and then so like there was this like the theory wasn't always working in practice, and investing is hard. If it was easy, then there would be free money, and there's just not free money. Like you have to have good knowledge. That's where the opportunities come from. But when I came about David Deutsch, it was almost, if not more, of an impact to how I thought. And I forgot how I came about him, but I bought his book in 2019, and I don't think it sat on my bookshelf for like a year or two. And I opened it up in 2021, and I highly recommend anyone that wants to understand the reality better. He's a genius of our time, and his ideas are so impactful. But I started reading it in 2021 and 2022 during the chaos of post-COVID and the volatility in the market, and it potentially helped me try to like frame investing from a knowledge perspective, and maybe helped me navigate things a little bit better. So, I mean, I'm always learning and trying to improve, but I do think the portfolio has generally been managed similarly, and I don't see it changing besides the opportunities that present itself. I'm just looking for value, if that helps answer your question. And then the other one was on industries, and, industries I like or don't like that I go into. And I don't think in terms of industries, I think in terms of problems and how a company is trying to solve a problem and its ability to do it relative to alternative solutions. And so what that would generally lead to is some industries have bad economics, like airlines or something. So airlines are solving a problem of transportation. It's a very valuable service and a great solution that they provide, but based on today's industry, there's no relative advantage of one over the other. There's some economies of scale, but that last seat they're trying to sell just hurts the economics of the business and makes it very cyclical, capital intensive. And then if you look at, let's say, used cars, like historically, used cars dealerships were not, like, it's not a fantastic industry. They were all relatively the same. Now, new car dealerships, they're little mini monopolies within, 15 or 30-mile radius within each city. But used car dealerships, there was no differentiation between them, and there's little economies of scale, and the economics weren't overly attractive. But when a model emerges where a certain company has a new solution to this problem that is so much better, and for others to try to replicate their solution is extremely difficult, then that makes me like that opportunity, which then gets me into the used car industry. If you look at like right now, AI is super hot. Like everyone, NVIDIA and looking at AMD and Intel and these stocks. And I think it's going to be huge, right? I think this technology is revolutionary, and I think it's going to change businesses and how people function. It's a huge improvement in technology. But I have no idea about NVIDIA's future. And NVIDIA, without a doubt, is a very strong company, and you can't ignore it, right? As an investor, I'm trying to understand it, and I think they have a platform, and they are so ahead in their technology. But can others replicate those really high gross profit margins? I can't really have a strong answer for that. I don't think I have an edge or a better understanding than the market for the company like that. And maybe I will one day, but that keeps me away from that opportunity. So I really am opportunistic. I go anywhere that I think is a good opportunity, and I do it from a bottom-up process as opposed to a top-down. So hopefully that answers your question.
Good. Thank you.
JR?
Thank you. First, congratulations on sticking to your knitting and reaping the rewards over a difficult period of time. Given the fact that I have two questions. One is, given the fact that values in the market are so volatile, and as your understanding of companies deepen, my first question is, what are you most excited about in terms of your current positions in the portfolio? And secondly, I just wanted to clarify, which of David Deutsch's books are you recommending?
Yeah. So your first question was where I see value today, given how things are so volatile. When I talk to investors, peers, or other people that manage portfolios, or just anyone who likes to talk about stocks, because that's a topic I love talking about, they say, what's your new idea? Do you have anything new? Like, you still own the same companies? And I don't own, so Saga's companies they change infrequently. And it's because, based on my understanding, those are the best opportunities based on my knowledge. And everyone's knowledge is different, right? There's no two investment portfolios that are the same. And so based on the current allocation of the Saga portfolio, that is where I see the opportunities. If the values were to change substantially, then I make the trade and I reallocate the portfolio according to that thinking. I think from the volatility and those valuations are based on my understanding, I think the valuations are very attractive. They're low relative to where I think they will be based on their profitability in 5, 10, 15 years. But I think one thing that, just talking about volatility, one of the things that a lot of people, and I don't want to speculate on how people also approach investing, but they do care a lot about the valuation multiple. They say this is expensive because it sells for 30 times its earnings, or it's cheap because it sells for 5 times earnings, or it doesn't have free cash flow, so it doesn't have value. That is not the approach I take. And so if the multiple goes from 25 to 15, there's so much more underlying that. It doesn't mean that it's cheaper at 15 versus 25. What matters is, where is it selling today relative to what I think it's going to be earning in 5, 10, 15 years. So the short answer is, the value I see today is based on where the Saga portfolio is currently allocated and the companies that's allocated in. And that's based on my understanding. And so your second question was about which of David Deutsch's books I recommended. I think the one that I really think everyone, if they wanted to understand things better and have a principle of optimism, it's The Beginning of Infinity. He also wrote the Fabric of Reality in the 90s. The Beginning of Infinity he wrote, I think, in 2011. And The Beginning of Infinity, it's just part of the investing process is to understand history, understand people, understand how knowledge grows. And so since as long as I remember, I live in Cleveland and born and raised, you walk around downtown Cleveland and there's skyscrapers, and you look at it as a kid and you say, how can people build these huge skyscrapers? How is it one person can't do it, but together we can? So what happened between 300 years ago to today, or even 100 years ago and today, to create this ability to do this? And so to learn that, you read about history, the rise and fall of countries, and all these books like Guns, Germs, and Steel, or one book I thought was really good, but it's Why the West Rules for Now, or one that's a really popular investing book, is like a Scale by Jeffrey West. All these books, they have good history and they kind of explain how things came about, but they all end very pessimistically. They say, we have had so much progress, but it's going to end, right? Like things are going to stop. We're going to destroy the planet, and it's impossible to continue this progress. And it always leaves you like, oh, like in the year 2100, humans are going to kill themselves. Like it's a very pessimistic way to paint the future. And I don't care if that's the case or not. I want a good explanation for why. The explanation has never made sense to me because it just said, we've had so much progress, so I can't keep going. It was basically what a lot of these authors say. David Deutsch explains the principle of optimism, which is all progress is due to growing knowledge. And the only thing that can constrain that are what the physical laws restrict. Basically, we can't go faster than the speed of light, or we can't create energy out of nothing. Essentially, knowledge has unlimited growth. So we can continue to solve problems and make more and more progress. And that's what the beginning of Affinity is about. And it's more of an open-ended, it's not that progress is definitely going to happen, it's just that it's possible. So we can go to Mars if Elon Musk is successful, or we can even go between solar systems. It's possible if we try to do it. I highly recommend The Beginning of Infinity. It's probably been the most impactful book I've read. So
Thank you.
I think I saw some questions in the chat. Juan asked, Trade Desk, is Amazon a direct competitor? Good. Yeah, that's a good question. It's the talk about going through volatility. So the Trade Desk has been in the portfolio since 2017 to varying degrees. There's so much I can explain about the experience of owning the Trade Desk and how it has opened up my eyes to other opportunities. But the Trade Desk is one of the best companies I have come about. And quick brief, the Trade Desk is a software platform for advertisers to purchase ad inventory supply from media companies. They help fund media companies. And there are strong economies of scale and network effects in this business, so that it leads to concentration within the industry. And the Trade Desk has become the largest independent demand side platform to allocate these ad dollars. There are huge tech competitors, most notably being Google's DV360. And then now an emerging competitive threat, or at least supposed competitive threat, is Amazon's demand side platform, as Amazon leaned into advertising. And so the way I think about Amazon, so since Amazon has really leaned into trying to grow its demand side platform, Trade Desk stock has crashed for various reasons. The market's view of Trade Desk went from, this is going to be a huge monopoly that's going to win the industry inevitably, to they're going to get disrupted and selling at near all-time low valuation multiples based on current fundamentals. But the way I think about Amazon is similar way as I think about Google. The key part of this is that you need an objective way to buy advertising. What Google, Amazon, and Facebook is their walled gardens. Facebook is not even in the business to help advertisers purchase inventory in the internet open. Like the Facebook says, all right, advertisers, you go onto our platform and buy Facebook advertising inventory, our media. They're not in the business of going to an advertiser and saying, okay, now you are using our demand side platform, and now I want you to buy ESPN.com, or I want you to buy, ads on Roku or wherever. So Facebook's not competing. They're a walled off garden. Google's demand side platform, where they are trying to sell it to advertisers, but it's stagnated, as in they've completely deprioritized their DV360. They're still the largest one out there, but if you look at the line item on Google, it's been flat for this business segment because of all the other things, all the antitrust things that Google are going through. Now, Amazon has entered the market a little bit more aggressively in the past year or two because they're trying to monetize their ad inventory on Prime Video. And that's connected television, which is where the Trade Desk really is. It's a strong part of the Trade Desk's business. And so potentially Amazon's going to ad agencies and saying, I'm going to lower the fees. You can use our demand side platform to buy Prime Video, and also maybe you want to buy Roku inventory, or you also want to buy Hulu and things like that. But at the core, they cannot get around this objectivity problem. So I think it's very hard for Amazon to try to be objective to an ad agency saying, all right, should you buy Prime Video ad inventory or should I buy Netflix or other CTV ad inventory? They can't do it objectively because they're trying to monetize Prime Video. The Trade Desk is objective. They're the ones that saying, I don't care where you advertise. I'm just going to try to do the best for you objectively. So to answer the question, yes, Amazon might be making a push into it, but I think long term, it doesn't get rid of this objectivity problem. And really, if you think about like Amazon's business, they're trying to sell, they have an e-commerce retailer, they have a data center, AWS, and now they're trying to monetize through advertising. The part of the business about the open internet, I don't think they're going to be successful in long term. I think they're going to want to monetize that Prime Video to the best of their abilities. But if you look at the whole advertising industry, let's say it's like a $1 trillion industry, and you look at where the walled gardens are, Facebook, Amazon, Google, and you look at what's the open internet, there's about 60% of that 1 trillion goes to walled gardens, like $600 billion, and about 300 or 400 billion is in the open internet, maybe 303 billion. What's interesting is where people are spending. So like that's kind of the Trade Desk's TAM is the open internet. And the part of the theory is potentially the walled gardens will open up their inventory to the open internet. But what's interesting about the open internet versus the walled garden internet of where advertising dollars are going, 60% of time that people spend is in the open internet. It's on premium connected television. It's outside of Facebook, Instagram, and it's outside of Google. Google, that's about 40% of the time spent, but 60% of the ad dollars go there because walled gardens can actually monetize their inventory easier as a part of the open ecosystem. But over time, the Trade Desk is trying to fix the value chain because there's a lot of middlemen in ad tech and how media companies monetize their ad inventory. And the Trade Desk is trying to streamline that value chain and make it easier as they're aggregating all of the very fragmented supply. So that's a long answer, but there's a lot to the Trade Desk and what the stock is currently going through. And part of what I also want to say is like the experience of like the last couple of years, like Trade Desk has been a big position for us in past years, and I sold it. As Carvana was selling down or Roku, I actually sold Trade Desk stock to buy those positions because I thought the value of Carvana and Roku became increasingly more attractive compared to Trade Desk. But during the whole time, Carvana, Roku, and those stocks kept crashing and going down, and Trade Desk stayed really high. And I said, maybe that long-term investing, like I should just buy and never sell, right? That philosophy, which is not how I approach it. I approach it based on a value approach. And then now Trade Desk is going through potential risks and the market has sold down the stock so significantly. And I said, well, now what I've done is kind of reallocate a little bit more to the Trade Desk based on where I think their value is. It's been very interesting experiencing owning a stock like the Trade Desk. They have competitive threats like every business does, but I think when you approach these huge markets, you're going to bump up against the tech giants. Or if you're very successful at business, others are going to try to take those profits. That's just the nature of business. That's why it's important to understand how knowledge impacts business. So part of the analysis is when someone inevitably wants to go after these profits, like if I'm going to invest in a company, they're going to become very profitable based on my theory. So eventually someone's going to try and take those profits. I have to answer the question, why are they able to protect those profits? If something were to change, then I adjust it. But I've already thought through the Trade Desk one, and I just can't get around that Trade Desk has a fundamental better position being an objective allocator in the open internet. And Amazon is not objective. So that's the Trade Desk. Hillman sent in a question. He said, you concentrated your portfolio even more over the years. Which of the sells was a reaction of a mistake you made? What kind of mistake was it? Oh, mistakes. I made a lot of mistakes. Well, I don't sell stocks because they go down or up. I sell when I think the value isn't there. And a recent one, it's true that the portfolio does appear to be more concentrated. I think it's not because the top 5 or 6 positions have always basically been 90+% of the portfolio with a few smaller ones here and there. And I've basically gotten rid of the smaller ones. And even more recently, I sold LGI Homes, and I don't even know it's worth spending too much time on it, but I've owned LGI Homes starting in 2017, sold it in 2021, and then bought it back in 2022, I think. And the stock has done very poorly. And I had this, and the business has been struggling. And so I've kind of had to think about, is the advantage I thought LGI Homes had changed. And I came to the conclusion, yeah, it also was a small position. And I think if I can't really get comfortable making a company like a 10% position, then is it really worth the work it takes to follow a company? And I partly owned LGI Homes as a way to track the housing market. I mean, it kind of forced me to really pay close attention to the home builders when I owned Redfin. And I guess Redfin is a much larger mistake that I guess is probably even more pertinent to your question. And Redfin was a hard one. I did make a big mistake with Redfin. I misjudged their value proposition and also misjudged what management would do. It was hard to know if their issues were idiosyncratic, like if it was just the company that was going through it, or it was macro, because what we've gone through in the United States in the housing market is almost unprecedented in the turnover of homes being sold. And so I thought Redfin would be able to get through that. Even after the stock crashed, I thought there was more value, but they eventually sold themselves to rocket companies for $1.7 billion. I still think that that is an undervaluation for what their assets were, but I thought they had a fundamental way of increasing the efficiency of agents. I still do think that, because brokerage fees for real estate are too high given the technology and that's available to people buying and selling houses. I thought Redfin was uniquely positioned to improve that because they had this asset of this website that was the third most trafficked website. The first one was Zillow, and the second one's Realtor.com. Realtor is tied to NAR, the National Association of Realtors, so they were stuck with maintaining high fees and brokerage fees for agents. And then Zillow monetizes as a lead generator for buying agents. So they were kind of stuck in their business model. While Redfin had this traffic where they could funnel it to their agents and really lower the fees they charge and make these agents more productive. And I thought that would scale across the country. And for various reasons, which I explained in the last investor letter, that wasn't the case, especially given just what has happened in the housing market. So that was hard for me to navigate because I wasn't sure if it was a business model issue or if it was a industry macro level, and that eventually would subside. So, and then once they sold, that was the end of it. That was the result. Fortunately, I was able to reallocate to better things, but that was a big mistake. Okay. BB says, sorry, I can't unmute myself, but it would be really helpful if you could talk about the Ventura OS platform that TD Trade Desk is trying to make, and do you think it would be a competition for Roku? Yeah, so Trade Desk and Roku, two positions in the Saga portfolio, they play in adjacent industries. Roku is obviously a platform for connected television, and the Trade Desk allocates advertising to connected TV ad inventory. And then a year ago, the Trade Desk announced that they are going to launch their own TV operating system, Ventura. The way I think about that is I don't understand. I think it will be challenging for Ventura to be successful, and I don't quite understand the Trade Desk's. I understand why the Trade Desk would like to have a successful operating system. It would be a great thing to have, like having an asset like what Roku has. But it kind of reminds me of what Roku did. They acquired DataZoo, which is a demand side. It was going to be a demand side platform that they wanted to use to help advertisers purchase inventory on Roku and also outside of Roku. And to me, I said that's outside the core competency, which is okay, but you have to have a reason why you're going outside your core competency and why there's not a better solution out there. That's what the Trade Desk does. And so I don't think that Roku would be very successful in trying to operate their own demand side platform. And it wasn't. They were trying to be a walled garden, like what Amazon's trying to do. But eventually they sold it off and they opened up all their ad inventory to the demand side platforms to help monetize their ad inventory, which is, I think, the right decision. Similarly, with the Trade Desk, potentially with the Trade Desk, they see how the TV operating system industry is developing, it's increasingly becoming concentrated into Roku, Amazon's Fire, a little bit into Google TV and Samsung's Tizen. Maybe they're trying to control it a little bit more, but part of the analysis of Roku is it's very hard to build an operating system, especially once they're established. And to me, I just don't see how the Trade Desk will be successful at that, but we'll see what they do with it. I don't, to me, I would recommend them to not do that, not because we're Roku investors, just because I don't think it's going to be a useful for the resources, but we'll see. Okay. Let's see. Padme has his hand raised.
Hi, Joe. Thank you for your presentation and thank you for taking my question. So I just had one kind of question on how you value businesses creating new knowledge, or how you think about businesses creating new knowledge. For instance, Carvana entering into acquiring some franchise dealerships and how that might open a new market opportunity, or how you think about valuing something like that. And then on the other hand, how you think about other businesses creating new knowledge and how that could have a disruption risk and how you value that. For instance, maybe stable coins disrupting Wise's business model. If it does disrupt Wise's business model, how do you think about evaluating these things?
Yeah, whenever there's a new technology or innovation, I try to think about potential new innovations or technologies, which helps direct where investments go. And that may never come to be the case, or may not. Like, for example, I mean, there's an infinite amount of examples, but for Uber, I find Uber's business model to be extremely attractive. It's something that I like. There's a network effect between drivers and riders, and they help logistically connect them. And it's been very successful. Even as an example of building their scale, where they had operating losses for years, and then once they are able to monetize, their cash flows just skyrocket. But I'm nervous because I can see there's technology. I've not personally rode in an autonomous vehicle, but you can see it out there that they're growing. I don't quite have a clear picture of how that will impact Uber. Potentially Uber benefits from that. Maybe you don't need to pay drivers. So it's less of a network effect and more of economies of scale because they've developed this app that's widely used. Or does Tesla basically disrupt Uber and become autonomous vehicles that help this ride sharing? And there's just too many questions that I can't answer. And so to bring it back to the Saga portfolio, like the future is so unknowable. It's so hard to navigate, right? It's a cloud. Like I have no idea what is going to happen over the next 10 years, but it kind of it reminds me of a quote that Jeff Bezos has said. And he says, what are the long-term things that matter? And the short term is 1,000 things, but generally it's lower prices, faster delivery, more seamless experience. And if I can find companies, I think customers generally like to pay lower prices. And so that's attracted me for companies that have a lower cost model that is not able to be replicated by others because of their network effects or potentially economies of scale. That's a very powerful business model. And so with Carvana, like with these companies that are very innovative and they have established themselves, they have this infrastructure. And they can use this infrastructure to solve the problems of today, but you can see like Carvana tries things, they experiment, they see what else they can do to provide value for customers. And right now they're trying to tackle the used car industry, but it's not inconceivable that they try to tackle the distribution of new cars and new car dealerships, which, they've acquired a few new car dealerships and are doing it very successfully. And the reason why you do that is because there's a lot of regulations and laws about doing online sales for new cars. The new car dealership model is due for disruption, just like I would think like the real estate brokerage commissions are due for disruption. So that's on the radar of how technology can improve and make things more efficient for customers and cheaper. But new car dealerships, they charge, extra 20% margin for, I think, not providing this, I don't want to talk for all of them, but providing a great experience. And they try to monetize in other ways. And it's a long process. It's clunky. For basically buying a car that you know that you want to pay for real quickly, and really you wish GM or do a Tesla directly getting it to your house. And so Carvana's infrastructure could pursue that type of opportunity if it makes sense for them to do. So I do like companies that are continually trying to utilize their infrastructure. But what I think is what I look for companies is like having that infrastructure. And so people ask, I talk about stocks with everyone and daily, and people will say like, not to hate on companies, but they'll say, why don't you own DocuSign? Like, why don't you own numerous other like software companies. And my answer is, let's say for DocuSign, potentially they build this platform or this important solution, but I don't know how a Google or a Microsoft doesn't do e-signing and have that as a feature of their broader suite. And I learned that lesson painfully a few times, where I don't know if there's network effects or economies of scale of this type of business model. And so they could be very successful, but I don't have a good answer for why they would be able to protect against having excess profits, right? These companies are going to make a lot of money and people are going to attack them. How can they protect against that competitive threat? And with Wise, what they're doing is they're building infrastructure around the world. The correspondent banking system to do money transfers internationally is so slow and it's expensive, and it's through the correspondence banking network that uses the Swift communication protocol. There's a link of banks that each charge fees, each take time to send money from. It could be from the United States to Canada. It could be from the UK to France, and there's fees. And so Wise, what it does is it has accounts in each country, and they're stitching together this network and having liquidity pools. So if I want to send money to the UK, basically in my Wise account, they take it and they give that money sent into the account in the UK automatically, instantly, and at a much cheaper price than going through the traditional correspondent network. It's an amazing network of money that improves a very big problem to be solved, because there's a lot of money that gets transferred internationally, and there's a lot of fees that are assessed on that. But your question was how cryptocurrency could potentially disrupt Wise, and this is it's really relevant because there's always news about how blockchain and cryptocurrencies are in the news daily, and the CEO is asked this question a lot, and I think he has a good answer. Cryptocurrency is a way to exchange tokens immediately. You could send some type of stable coin, let's say a US stable coin, USDC or something, to Europe instantly. But what the real problem that Wise is solving is fiat currencies. And potentially like the crypto bulls, that Bitcoin bulls, they think that it's going to take over fiat currencies of governments. And I don't see that, and I don't think that's going to happen, because governments want to have control over their money, and there's 180 currencies around the world. The problem that needs to be solved is, I have this fiat currency in the US, I want to then have this fiat currency in France or England or Japan or Mexico. I need to then put this fiat currency into this Wise account and then take it out. For blockchain, to actually have the stable coin, you still need to convert from US dollars to the stablecoin US dollars, then transition that into euros or whatever, and it's not efficient. It doesn't really solve that problem. And if that technology does solve this problem, and I don't think fiat currencies are going to go away, maybe long future, but I don't think anytime soon. There's a use case for stablecoins and blockchains and things like that, but I think Wise would be the company that can incorporate that technology, and they're constantly looking at technologies to improve their infrastructure. So those are my thoughts. I mean, something to continue to watch and pay attention to, but I don't think it's going to disrupt Wise's business model.
Very helpful. Thank you.
Thanks. Okay. Casey says, why decided to remove Meta, Facebook Meta? When you discuss your philosophy, it seems like their moat investment thesis per se isn't disrupted. How do you make decisions about removing companies that have an investment thesis that you like? I love Meta. I think it was a really successful investment for us. Again, it was our experience with Meta was really interesting. Of all the companies that we owned, it was the largest one, most followed, and arguably had the highest quality cash flows and business model. It was well recognized to be the winner in social media and generating so much money. And we owned it. I bought it in late 2018 when it was going through it's funny because the risks of Meta when we bought it were that it was too profitable and it would be regulated and have fines, right? Like they were using the data inappropriately, whether that was or was not the case, and they were monetizing it. And so that would be regulated away. Meta stock was really hurt when we bought it. It was selling at a very low valuation because it was too profitable. And then in 2022, based on numerous things like Apple's changes in how you can collect data on the iOS and also the rise of TikTok and things like that, and the investments that Meta was making into virtual reality and AI and things like that were using up some of its cash flows, the stock crashed. So it went from I forgot what it was, $300 or something, down to $90. And I owned it the whole way. It was wild to go through like a 75+% drawdown in a company that I thought was, I don't know, it was shocking to own a company like that. So it happens to the best of companies. And then it obviously recovered really quickly once the narrative changed. But I did sell it. And I sold it largely towards the end of, when did I sell it? End of 2023, beginning of 2024. And it was because I still thought Meta would be a successful investment. But I remember having conversations in the fall of 2022 about Meta to people. And at that time, it was selling for maybe a $300 billion market valuation, which was crazy to me. I said, I don't know what's going on, but this is wild. But I'm like, I said, I think, I mean, like, I don't know, but I think like there's a good case to be made that Meta could potentially be worth like $2 trillion based on what I think will happen. And then once it got to like a $1.4, $1.5 trillion valuation, I said, like, it's still really attractive. I think it will earn returns above the S&P 500 from here, but I like these other opportunities more. It's less attractive. And so it's not like I'm buying Meta and holding it and sticking my head in the sand and not looking at relative valuations. Also, I mean, part of Meta is like, I think a lot of attention has been spent on the reality labs and how much money they're investing and losing in reality labs. And I think that those investments can potentially come to fruition and be huge, right? They could be the operating system of the future of virtual reality. But I can't make a judgment call on that. I valued Meta on its social media platform and their ability to monetize that because I think they're dominant in Instagram and Facebook. And I don't think those are going to go away, but I do think that the amount of ad dollars that have gone to Google and Facebook are saturated. I don't, these valuations imply that they can continue to grow off the current base at like, I don't know, 15% and grow. And the thing is, that's why Google and Amazon and Facebook have outperformed so much over the last 10 or 15 years, because everyone says they can't continue to grow at these rates. Like there's a law of large numbers and trees don't grow to the sky. But I just think the ad revenue part of their business is not going to grow at such high rates over the next 10 or 15 years. The valuation was more fairly valued. I think it's a great company, but I like things like the Trade Desk better. So, okay, let's see. So, if anyone, thanks, Casey. I don't see anyone with any other questions, unless there's something in the chat. Nope. All right. Well, if there's no other questions, I want to say thank you for attending and coming to Saga's annual meeting. I really enjoy having people come. I enjoy talking about the portfolio. I hope it's helpful and helps you better understand how it's managed. I can't believe a year has gone by since the last time we had one, and I bet the next year will fly by just as fast. So thank you again, and I hope you have a good weekend. All right, thanks everyone.